Good morning, everyone. Welcome to this month's educational seminar on the topic of wealth management, RSP, tax planning tool. I'm your host, Roop Singh. I run a wealth management practice at RBC Dominion Securities. 2020 has been an interesting and challenging year for every Canadian, and many Canadians rely on the advice to help them navigate through various life cycles. This is that time of the year where everyone reflects on their personal financial situation, plans for the upcoming year. Our intent for today's session is to address what's top of your mind regarding to Registered Retirement Savings Plan, commonly known as RRSP. During the session, if you have any questions for our presenter, please submit them to your host and presenter myself at roopmeet.singh@rbc.com. So for today's session, we have a special guest, Amandeep Singh. He's a partner at Cloudyworks CPA. Aman will share some critical insights about a very important topic, RRSP. Welcome, Aman. Before we begin our dialogue, tell us about yourself and Cloudyworks.
Hi, so my CPA firm is called Cloudyworks CPAs, and we offer accounting, tax, and consulting services here in Metro Vancouver.
Nice. Aman, RSP has been a common topic everywhere. Why do Canadians hold RSP? Just like as an explanation you can provide to our audience today. Why do they hold RSP?
Yeah. So basically, an RRSP is what we call a tax advantage account. So meaning that the government created them specifically to provide tax breaks to those who invest money in RRSPs as a way to motivate them to put away money for their retirement. So, basically annual contributions to an RRSP can be used as a tax deduction. So this reduces the amount of tax a person will pay on their income. So Canadians who invest into various securities such as stocks, mutual funds, ETFs can do it through RRSP account, which is a tax advantage account.
Okay, fair. So we all know that RRSP serves as a cornerstone for the retirement planning. Aside from contributions being tax deductible and the savings that they are, depending on what kind of securities you are buying into that RRSP, grow tax-free. So as a Canadian, is there a limit how much you can put the money into RRSP, or is there a certain dollar amount?
Yeah, so I know, although RRSP is a great tax planning tool, however, unfortunately, you can't just put as much money and file away as much money as you want into these accounts. The RRSP deduction limit is 18% of income earned in the previous year, up to a maximum of $27,230, which was in 2020, minus any pension adjustment or past pension adjustment, plus any pension adjustment reversal and unused contribution room from previous years. So let me give you an example. So let's say you made $100,000 in 2020. Well, the amount of contribution room that you might have available would be $18,000 now. So, and if you don't use the contribution room, that's completely fine. It's cumulative. So each year, the space you don't use will add up, building up more and more contribution room. And, maybe the listeners are curious, what is their contribution room? So, they can check their federal notice of assessment from the previous tax year, which will clearly mention what is the contribution room. And they can use that and then contribute up to the contribution room, which is listed on the notice of assessment.
So, Aman, is this information readily available as well if I want to search somewhere online, or it is just through a federal notice of assessment as a physical copy?
So basically, if the client, let's say, if you want to do it, you can just log on to your CRA My account. And if you go and see your notice of assessment from there, you can find it. So that's the best way of being sure that what is your RRSP amount, like what's your room. I mean, you can also calculate it, but I'll always trust what the government says on that and use the notice of assessment.
Yeah, you're right. In my practice, I see more than 95% of my clients have RSP accounts with us. RSP is considered one of the favorable tax planning tools for them. However, if we reflect back on last year, 2020, due to coronavirus-related layoff, many people depleted their savings. What would be an ideal approach for 2021 they should be looking for in order to top up their RSP contribution so far?
That's a very good question, which is very relevant in these times. While it's always best to use the savings to invest, this might not be feasible if there are no savings. So one of the approaches that some clients use is to take out a loan to invest through their RRSP or their TFSA or RESP. But you have to always be mindful that if you borrow to invest through a non-registered account, you can get a tax deduction for the interest on the loan which you take in order to invest. But as soon as you invest your money into an RRSP, which is a registered account, the tax deductibility suffers because you cannot get a tax deduction for investing into an RRSP, which is a registered account.
Okay. I just got a question from the audience. So, Aman, we know that we are permitted to contribute to an RRSP up until December 31st of the calendar year, or up until when the taxpayer or their spouse turns 71. So what happens if the RSP contribution is withdrawn before the age 71?
Well, that's a very common question. I always say that be wary of withdrawing early, unless it's for dire emergency or a withdrawal under a home buyer's plan or certain specific situations. Withdrawing your RRSP early is generally a bad idea, I would say. This is because you'll have to report the amount you take out as income on your tax return, and you won't get back the contribution room you originally used. You see? So, early withdrawals also means that you lose the power of compounding. So, had you left that money into an RSP account, it would compound, and you can earn the benefit of compounding, and the growth multiplies. So you lose the power of compounding by withdrawing early. Another thing I would like to mention here is that while some tax is withheld at the time of withdrawal, it may not be enough to cover the full amount of income tax that will be owing. So, so that is, again, not a good strategy to withdraw early. So instead, if you really want the funds and if you have some money in your TFSA, withdraw money from that. And then there are no tax consequences for that.
So if I reflect back on the suggestion that you are, as an accountant, you're suggesting to Canadians is first focus on getting from non-tax sheltered accounts or investments, use that money, then use money from your TFSA because it is, again, tax-free growth. And whatever is left over, if you still need money, take it from your RRSP. But the maximum that you can push not taking money out from RRSP is up until the age 71.
Yeah, that's right. Yeah.
Okay. On this particular note, I just got a follow-up question on it. We know that RRSP reaches the maturity on the last day of the calendar year when the taxpayers turn 71. So what is the process? How can a taxpayer access that RRSP asset?
So that is, again, a good question. So if you want to access your RRSP assets, you need to be very careful. You have around 3 options to do that. One option is to do a lump sum withdrawal, but I don't suggest to use this option because this is the most tax costly option, because as soon as you withdraw the money, you're going to get a tax hit. So I always say don't do a lump sum withdrawal for that reason. The second option is that you convert your RRSP into a registered retirement income fund. What that does is that although it requires you to withdraw a minimum amount each year, as long as you stay within the minimum amount of withdrawals, there is no tax deducted at source. Of course, the money which you withdraw will get taxed eventually when you file your tax return, but there's no tax deduction at source. So this is really a good way because you can split all of your taxability, tax exposure over many years rather than just withdrawing everything at once. So this can be a very good source of retirement income funds and gives you steady flow of retirement income.
Mm-hmm.
And there is, so I remember, I remember there was a third option also, which you can use, is that you can convert your RRSP to an annuity. So this
Okay.
offers a guaranteed income for life or for a specified period. Withholding tax is not applied on amounts that are used to purchase an annuity. So you may
Mhm.
have to pay tax on the amount when you start receiving the payments. Yeah, so that's the third
Okay.
option. Yeah.
Okay. All right. And it all depends on client to client in their personal situation, which one would be more favorable, which one would be less favorable. Is that correct?
Definitely. That's right. Yeah.
Okay. Yeah, Aman, one of the other questions that usually in my practice I come across from my clients is about spousal RSP. The questions are sometimes specific to, hey, should I contribute towards my spousal RSP? Should I not? Etc. Etc. So, what's your take on a spousal RSP?
Yeah. So, see, the key benefit of spousal RRSP is to do income splitting effectively in retirement. So
Mhm.
you have to access your financial situation and make a prediction of where you think you're going to be in retirement. You know?
Mhm.
So what are your and your partner's sources of income in retirement? So that's the question. So should one person have a lot of money in their RRSP and the other have less in their retirement, they may pay more income tax. So had each person evened out their contributions, they could potentially pay less income tax in retirement by being in a lower tax bracket. So, your spouse or partner will see a tax-free return on that money as well until it is withdrawn.
Okay. Yeah, Aman, thank you for sharing some great insights today. I think we all walked away with this 15-minute session with you with some key takeaway learnings. What stood out for me personally was the most important thing of waiting up until the age 71 to draw on your RSP and like having a plan of first going for non-tax sheltered TFSA and RSP. That may work for my personal situation. So that could be one of the options, one of the strategies clients may like to use. However, they need to evaluate that with their own accountant or their own advisors. And there are many other great points as well the audience can benefit from. So again, thank you once again for joining us today, Aman. That brings us to the end of our call. I want to thank all of our attendees for taking time to attend this seminar. If you have additional questions, please connect with Aman directly at his email address. It's on the screen, as well as send an email to me to learn more about our RBC Wealth Management service offerings that we have and how they can benefit you. Thanks all, and we will see you in the next seminar on another relevant wealth management topic.
Thanks for having me, Ru.
Thank you.